Oh.
Smita.
We begin. Welcome everybody. On behalf of Pune chapter of CA Institute, Pune branch, I welcome all of you to this 5th day of the DTRC. I welcome all the panelists. We have with us, Chitale sir is there? Chandrasekhar Chitale sir, who is CCM ICAI and Chairman of Direct Taxation Committee ICAI. We have the panelists, CA Manoj Fadnis, who is past President of ICAI, CA Neelesh Khandelwal, CA Vilesh Dalya, and for today's panel discussion, the moderation will be done by CA Krishna Gujarathi. I also welcome CA Sameer Ladda, who is the Chairman and Treasurer of Pune ICAI, CA Kashinath Pathare, Vice Chairman and Secretary of Pune ICAI, and Chairman of Taxation Subcommittee of Pune ICAI. May I now request our President CA Sameer Ladda, our Chairman CA Sameer Ladda, to give a welcome address.
Well, thank you, Smita. CA Manoj Fadnis sir, past President of ICAI. Other eminent speakers today, CA Neelesh Khandelwal sir, CA Vilesh Dalya, CA Krishna Gujarathi, the moderator, and today's MOC CA Smita Kunte, and all the August audience. Welcome again, last day of the DTRC organized by Pune branch of ICAI. I sincerely thanks all the participants for giving sincerely attending and participating in last 6 days in the DTRC. As you know already, DTRC is was pioneered by, started in the I think 88, 89 when the Chitale sir was chairman of the branch, and this DTRC is going continuously going on up today, and in upcoming years also. Every year there will be DTRC for the Pune branch of ICAI, as it is one of the most favorite program of the members of Pune ICAI. It's our privilege that we have experts like Neelesh Khandelwal sir, Vilesh Dalya, and Krishna Gujarathi for the DTRC from Pune, and जैसे सोने पे सुहागा बोल सकते हैं वैसे मनोज फडनीस सर, it is privilege sir that you have given time to us, past President of ICAI for DTRC of Pune. Thank you very much, Fadnis sir, and all the today's speakers. Welcome and thank you on behalf of Pune branch to you for giving your valuable time for the DTRC session. Thank you, Smita. Wish you happy learning, all the participants. Over to Smita for further process.
Thank you, Sameer. Is there any Chitale sir or Pathare sir is there who would want to address?
They are expected to join.
Okay, so right now
you can continue.
Yeah, we'll just move on to the introduction of our eminent panelists. Let me introduce our first panelist, CA Manoj Fadnis sir. He's the past president of the CA Institute. He's the immediate president of Confederation of Asian and Pacific Accountants, CAPA, CAPA, a regional international organization of 32 professional institutes from 23 countries from Asia and Pacific region. He has graced many positions in the past in various professional bodies, such as the president of the CA Institute, the vice president of the ICAI, chairman of the Standing Committee, Disciplinary Committee and Board of Discipline, non-executive director of the IRDA, which is Insurance and Regulatory Development Authority of India. He has been member of the National Direct Taxes Advisory Committee of the Central Board of Advisory Committee. He has been the member of the Company Law Committee set up by Ministry of Corporate Affairs, Government of India. He has also been nominated on B20, which is a business group formed by G20 based in Buenos Aires, Argentina. He was nominated by State Bank of India as a director on the board of State Bank of Indore. Presently, he is independent director on the board of Federal Bank and also serves as a chairman of the audit committee. May I now request may I now introduce our second panelist, CA Neelesh Khandelwal. CA Neelesh Khandelwal, he is a partner with Shah Khandelwal Jain and Associates. He leads the direct taxes practice there. He is expert in direct taxes litigation support. He specializes in international taxation, transfer pricing, and litigation. The one particular area where his expertise lies is formulating litigation support strategy for various revenue authorities and for diverse industry verticals such as manufacturing, real estate, automobile, etc. He has hands-on experience in private dispute resolution, family settlements, and succession planning for family-run businesses of many reputed groups. In the past, he has graced many positions at professional and social bodies. To name a few, he has been the managing committee member of Pune branch, president of Pune Chartered Accountant Society, MCM of ITAT, Income Tax Appellate Tribunal, Pune Bar Association. He has been president of Pune Midtown Roundtable 65. Now I'll introduce our third panelist, CA Vilesh Dalya. He has been fellow member of the institute. He has been practicing since the year 2011. He is a partner of SNK and Company, presently handling all Pune branch operations. His expertise lies in the area of audit and assurance services and direct taxes. Now I'll introduce our moderator, CA Krishna Gujarathi. He is a partner at Vipin Gujarathi and Associates, Chartered Accountants. He started his career with internship at Grant Thornton in international tax transfer pricing. His focus area of practice is income tax. He has rich experience in search and seizure assessments and appeals. He appears before CIT Appellate and ITAT. Since the last 8 years, he has appeared before Income Tax Settlement Commission, and he has keen interest in capital markets, specifically equity markets. He has been appointed as an advisor to a wealth management firm and as consultant to SEBI registered advisors. He delivers lectures at Pune branch of ICAI, and he is more inclined towards deliberations and interactive sessions. So I welcome now all the panelists and our moderator. I hand over the things to CA Krishna Gujarathi now, and we can begin with our panel discussion.
Yes. Hi, good evening to everyone. I hope I'm audible.
Yes, you are.
Yes, we are at 6:10, and the topic for today is recent judgments of the Income Tax Appellate Tribunal. Income Tax Appellate Tribunal, as everyone is aware, is the final fact-finding authority, since upwards of that High Court or a Supreme Court only entertain substantial questions of law. So, and never, even though that is the case, Income Tax Appellate Tribunal also lays down a lot of judicial precedents which are regularly followed by, I mean, they are binding on CIT appeal and the assessing officer, and they set very important precedents again. Sorry. So we have three panelists today who have prepared for you. I mean, read and prepared a factual matrix and the outcome and what could be the takeaway from specific judgments. And we'll go one by one to each speaker. First, we'll go to CA Neelesh Khandelwal. With he'll be briefing us and giving us the takeaways from a judgment of Honorable ITAT Mumbai bench in the case of Moralji Realties. This is a judgment pertaining to a definition of capital assets. I'll hand it over to CA Neelesh bhai.
Good evening, everyone. Pleasure to be amongst all of you all today. The decision that I wanted to discuss with all of you all and bring to everyone's notice was in the case of Morarji Realties Limited. Two very interesting issues that had come up in this case. This particular decision, interestingly, is a decision on the miscellaneous application filed by the assessee. Miscellaneous application filed on two concluded grounds. So there were two grounds which were concluded against the assessee. And later on, the assessee raised or filed a miscellaneous application saying that a jurisdictional high court decision, which was which was available before this decision was made, directly covers the issue which was decided against the assessee. And therefore, what was pleaded is that there is a prima facie error in the judgment of the tribunal. So a tribunal passed a judgment relying on certain decisions. A miscellaneous application is filed saying that there is a direct decision of jurisdictional high court which is binding in nature, which was available before this judgment was passed, and therefore there is a prima facie error, and therefore that should be entertained, was one issue that was involved. The other issue that was involved is whether share application money, being in the nature of advance, would constitute capital asset as defined under section 214 of the Act, and consequently loss arising on transfer of such share application money would be allowed as long-term, short-term, whatever is the tenure of the money, as a loss. So these were the two issues which were before the Honorable Tribunal. The facts were, as a part of corporate restructuring exercise of the group, the assessee had transferred certain shares as well as share application money to a group company. On such transfer, the assessee suffered long-term as well as short-term capital losses, which were denied to be set off by the assessee. Now, the share application money and the shares which were available in the books of the company in the restructuring exercise, they were being transferred to the group company at a lower price, and therefore this loss was determined in the books. The tribunal in its earlier order held that the share application money, being in nature of advance, could not be held as capital assets within the meaning of section 240. Then subsequently, the Bombay High Court in its judgment in the case of CIT versus Siemens Nixdorf Information System GmbH answered the question in favor of the assessee. Hence, the assessee filed a miscellaneous application before the ITAT. Now, the first issue before the ITAT was the ITAT, whether a miscellaneous application could be allowed on issue that was finalized by the tribunal. So the tribunal has come to the conclusion that since there was a Bombay High Court decision on similar issue and it was binding on the tribunal, which was not considered by the tribunal, even though it was not pointed out by any of the AR or the DR, there lies a miscellaneous application which will have to be entertained because there is a prima facie error. So the first takeaway is that if there is a jurisdictional high court decision, then it is binding on the tribunal whether or not anyone has pointed it out. And a miscellaneous application, if that has not been considered while giving the decision, then a miscellaneous application can be filed and the tribunal will have to reconsider the decision. The second issue, which was regarding the share application money not being treated as capital asset in terms of provisions of section 214. The ITAT in the earlier decision, in the original decision, had held that there was a decision of Pune bench in case of SR Thorat Milk Products. Now, in this, what had happened was the facts of that case were that in SR Thorat Milk Products, there was share application money which was received by the company. Against the share application money, interest was being paid to the people who had given the share application money. So this interest was claimed as deduction in the hands of the company. the AO said nothing doing, share application money is capital receipt. Since it is a capital receipt, the interest expenses that are being claimed will not be allowed because this is not revenue in nature. The tribunal came to a conclusion that share application money and the share capital, the equity share which are actually issued, these are two different things. Since share application money has been received and interest is paid on that, and it is distinct with share capital, the interest paid on that was allowed as deduction. Relying on this decision, the tribunal had come to a conclusion that share application money is not a capital asset. Subsequently, in the Siemens decision, what had happened was the High Court, the Bombay High Court, held that the word property of any kind held by the SSE, whether or not connected with the business or profession, used in section 214 of the Act is a word of wide import and would include all kinds of interests held by the SSE. The Bombay High Court, while passing its judgment, considered and relied on two other judgments. One was Baba Bhai alias Lav Kumar Kantilal, which was reported in 5 Taxman 121 Gujarat. In this particular case, the Gujarat High Court was dealing with a case wherein an unsecured creditor could only realize 45% of his debt under a scheme approved by the court since the debtor company went into liquidation. It was contended by the SSE that his rights in the debt to the extent of 55% stood extinguished as a result of liquidation and hence claimed a short-term capital loss. The revenue urged that no consideration passed on to the SSE as a result of the said extinguishment, and hence there was no capital gains loss arising out of the transaction. On the said facts, the Gujarat High Court held that the amount received by the SSE to the extent of 45% of the debt would amount to consideration for the extinguishment of rights to the extent of 55%. Now, the Bombay High Court stated in the said judgment has relied on the Gujarat High Court regarding this write-off and extinguishment of rights. Also, the Bombay High Court relied on Bafna Charitable Trust, where here again there was a mortgage which was created, and this mortgage, whether this is a capital asset or not, whether this can be included as application which a trust can do for claiming deduction under Section 11, those kind of issues are involved. The issue that was decided in Bafna Trust was whether what is the meaning of capital asset under Section 214, where again they said that 214 has a very wide import and such capital asset will be covered under the definition of transfer under Section 247. So based on these two decisions, the Bombay High Court came to a conclusion that unless it could be pointed out that the property was hit by any of the exclusions provided in Section 214, and those exclusions are where it is a stock in trade or consumable stores or raw material held for business or profession, personal effects, agricultural land, and certain bonds. These are what are excluded from the definition of asset. Then the rights in an advance given to a subsidiary company would fall within the definition of capital assets, is what the Bombay High Court held. This was applied further in Reliance Natural Resources Limited, which is reported in 623 of 2017, dated 26th August 2017. Thus, relying on all this, the ITAT held that the share capital being in nature of advance, the same would constitute to be a capital asset, and hence loss arising on account of transfer of the same would be allowable loss under the head capital gains. Yes, Krishna, this is what this judgment is about.
Yes. Again, to the audience, I apologize. I forgot to mention the modus operandi of taking questions. We will be taking questions after every case is discussed immediately. You could note down your questions in the, there is a Q&A box. if you could jot down your questions for this case and the case coming up after this can be taken up together because they are on the same issue, a similar issue. So, Nilesh sir will take questions on this case along with the next case.
No problem.
Yes. To the audience again, I apologize if you could just please put down your questions in the Q&A tab. Vilesh sir. Yes.
Yeah.
The next judgment is again from ITAT Mumbai bench, DCIT versus Manish Pharmaceuticals, ITA 4024 of 2019. This is a similar case relating to capital assets versus a business loss, where there was a write-off of investment in foreign subsidiaries. CA Vilesh Dalya will present the case, will speak about the case.
So basically, in this case, it has happened this way. Okay, the company has created a subsidiary overseas, and the main purpose of the creating a subsidiary was to expand and to give a global presence to the Manish Pharmaceutical, the assist. But somehow it didn't work out, and there were very heavy losses and everything. So ultimately, these amounts were written off and claimed by the assessee as a business loss. The AO said, okay, no, it's not business loss. CIT appeal allowed and went to the tribunal. It's a revenue appeal, we can see. So after analyzing all the facts and everything, the Honorable Tribunal has come to a conclusion that money, what was invested into the subsidiary, was not for the acquiring the manufacturing facility or to create any infrastructure facility. It was a part and parcel of the business, we can put it this way, to expand and give a global presence. They were required to create a subsidiary, and whatever the goods were manufactured in India, those were sold abroad, repacked, and sold ahead. So this is nothing but to expand, to scale up the business of the Indian entity. So when this issue came up, it was argued this way: it should be treated as a capital investment, not a revenue nature. But the most important thing, which the bench has noted in the going with the squarely ratio applicable in case of Patnaik and Patnaik Company Limited Supreme Court judgment, High Court Bombay judgment of the Colgate family, and ITAT Mumbai for the Camden India, wherein all have been squarely ratio applied, which says that whenever there is such type of business expansion going on, this should be not treated as a capital investment. It can be treated as a revenue. So whatever the investment they have made, it was for the layering of the business, but virtually it is a assessee own expansion of the business. So in that case, it has said it should be treated as a revenue only, not as a capital thing. So the main ideology or main crux over here was this: the substance over the form, which they have said that this is meant not to go for the manufacturing facility. They have done to procure the license, being a pharmaceutical company, to expand their presence over there, to procure the license, to distribute this thing, the drugs and everything. So they have gone with that multi-layer companies. So ultimately, when that amount was invested over there, it didn't work out, and there have been huge losses has been piled up. So the assessee claim as a revenue, and which was given, which was allowed by the tribunal. Yeah.
Yes. So from both of these judgments, there is not a stark difference, but a very fine line it appears. So if I could put a question to both of you sirs, because just to summarize again, Moralji Realties ITT Mumbai, the case that CA Neelesh Khandelwal ji has discussed, there the share application money in the nature of advance that has been allowed as a capital, that has been stated to be a capital asset, and the loss arising on the transfer of such share application money is allowed as a capital loss. Am I right, Neelesh sir?
Correct.
Yes. And in a single line, with respect to the case of Manish Pharmaceuticals that we have discussed, it was a loss on write-off of investment in a foreign subsidiary. It as against a simple loan or an advance. It was an investment. However, the same was allowed as a business loss. It was allowed as a deduction against the business income.
Business loss. Yes. Yes.
So, sirs, either of you could choose to answer this. Question number one is, where is the fine line between the categorization of capital loss and business loss?
So interesting question, Krishna, because to look at it, prima facie, it seems that both were investments in related party companies, and one has chosen to claim it as capital loss, the other has chosen to claim it as business loss. Now, if we look at the factual matrix, what has been discussed in both the cases is absolutely different. In one case, which Vilesh has pointed out, the plea of the assessee was always that I am doing business expansion. And therefore, the money that I have put in is towards business. It is for my own business, for my own, what do you say? It is going to give me revenue income as we go ahead for the business in hand. That is not the claim of the in the case of Morarji Realties. Morarji Realties, it is saying that we gave share application money. The companies must be doing different businesses. So it is not necessary that I gave the money with the intention that my own business is going to increase. Now that money has gone fat. It is, I'm unable to recover it. Now, once I'm unable to recover it, if you say that this is not revenue expenditure and you're not going to allow me as revenue expenditure, am I not supposed to get this loss at all? And that is what, so both the decisions now throw open a window to the assessee that if you have lost money, either on way of capital or on way of revenue, in both the cases, once you've lost money, you should get a claim.
So, from what you're saying, it appears, sir, that the moment you argue a nexus with the business commercial expediency of your own business, even an investment in a subsidiary, investment by way of subscribing to shares of a subsidiary, and may I go, I mean, beyond, if it is an unrelated party also, where my supply is being in consideration of the supply of raw material or any even a customer's company's capital, if I subscribe to the share capital, it is a these judgments, though not discussed so much, they are landmark judgments in a sense that it opens a door for a business or a capital loss claim based on the facts.
Yes.
Yes. Vilesh sir, would you want to point out anything on this?
Vilesh, Krishna is asking you.
No, I missed it. The internet connection is slow. Sorry.
Would you like to add to this or what Neelesh bhai just said?
No. It's perfectly.
Yes. Just one small question on this. One question. Can this be extrapolated into the essay builder's judgment, wherein if commercial expediency is justified, is explained and substantiated, the expenditure of the said company for the purpose of making this investment will be allowed? Is this fortifying essay builder's judgment on the second order effect? Is what the question is.
Yes, because ultimately when it comes to the expediency, the commercial, it's nothing, but it's very applicable. So even it can be this thing applicable. Yeah.
So it is fortified the same way.
Yes.
Okay, we'll go to the next judgment. We have CA Manoj Fadnis sir. So absolute honor to be with you on this platform today. Sir is discussing a case with us and he is giving us his insights on the case of ITAT, Delhi ITAT. The case name is DCIT versus DLF Assets Private Limited. The citation is 4965 of 2016. Sir, if you please.
Thank you, Krishna. Great pleasure to join this panel, and I'm thankful to our Honorable Council Member CA Chandrasekhar Chitare for this invitation, and also thankful to the chairman of Pune branch. Very interesting questions were discussed in the earlier when the two panelists made their presentations, and I must compliment our moderator CA Krishna for the kind of judgments which he has picked up and the issues which are arising therefrom. So the issue which is given to me for discussion is, as mentioned in the case of DLF Estates Private Limited, a decision of the Honorable Delhi Tribunal, which has been pronounced very recently in January 2021. The issue here relates to claiming deduction under Section 80 IAB. Now, as we all are well aware, this section is with respect to developers carrying on the business of SEZ developments, and where there is a income arising from the business activities relating to the development and carrying on the business of SEZ, the deduction under Section 80 IAB is allowable. Now, in the particular case which I am discussing is the income was offered under the head income from house property. Normally, it should have come as an income from business and there would not have been any dispute in claiming the deduction. But since in this case relating to assessment year 12-13, the deduction was, the income was offered under the head income from other source, income from house property. And that is where the dispute arose, because the assessing officer denied the deduction available to the assessee under Section 80 IAB on the plea that the income is not arising from carrying on the business and is therefore not offered for taxation under the head income from income, profits and gains from business or profession. Now, when the assessee carried this matter before the first appellate authority, the Honorable CIT Appeals was pleased to allow the appeal of the assessee, and then the matter has travelled before the Honorable Tribunal arising from a appeal filed by the department. The decision of the Honorable Tribunal, which also has followed the decisions of two decisions from Chennai tribunals, is on the reading of the Section 80 IAB. So what has been read out and what has been held in this section is that it is important that the business of carrying on the undertaking of a SEZ is important. What is not important is the head under which this income is offered for taxation. And that is the very fine distinction which has been made by the Honorable Delhi Tribunal, also following the decision of Honorable Chennai Tribunal. And I'll read out those decisions. One is in the case of High-Tech Infrastructure Private Limited, Coimbatore. And the second is Lulu Tech Private Limited, Lulu Tech Park Private Limited. So in both these decisions of Honorable Chennai Tribunal, a similar reasoning has come out that the business should be of carrying on the development of SEZ. And if that business is being carried out, there is evidence to that effect that the SSE was engaged in the development of SEZ and not necessarily in carrying out the business of units which are approved in the SEZ. So that is the fine distinction which has been made in both the decisions of Honorable Chennai Tribunal, which has been followed by Delhi Tribunal, and the matter has been held in favor of the SSE. So this really brings out the effect that to claim the deduction under 80 IAB, it is the business which is more important is of development of SEZ which should be carried out. It is not so important as to the head of income under which this income is offered for taxation. So a very simple judgment, very good judgment following two decisions of Chennai Tribunal.
Thank you, sir. Sir, if I may just take a question on this. Before I take this question, sir, does the judgment speak about the head under which this income is to be taxed, or does it only speak about that deduction should be allowed, notwithstanding the head under which the income is charged to tax?
Exactly. So that is the crux of the decision, that in the sense that what the in all the three decisions, what has been held is that what is important is that and I'll read out from the decision of Chennai Tribunal in the case of High-Tech Infrastructure, which has been quoted in this decision. And that is the reasoning which has been followed also in the case of Lulu decision. And therefore, now there are three decisions on this point. What it says is what is contemplated in Section 80IB of the Income Tax Act is the business of developing a SEZ. It is not the business of running eligible units approved by the competent authority. In the present case, that is in the case of high-tech developers, in the present case, SSC is a developer. It did not do any other business to claim the benefit of deduction under 80IAB. So the fact that the income was offered under the head income from house property does not become that important, as was the view taken by the learned assessing officer.
Thank you, sir. So a question has come up, sir. CBDT Circular 16 of 2017 states that the rent from SEZ and industrial parks shall be chargeable under the head income from business.
So that is not the issue in this case. What is the issue here is this is relating, as I said, to assessment year 12 and 13. So in this case, in the assessment year 12, 13, the SSE had offered that income not under the head income from business and gains from profits and gains from business and profession, but under the head income from house property. So notwithstanding that, the tribunal has held that the deduction under Section 80 IAB would be allowable to the SSE.
Okay. So the question, so just to take the final, what still leaves food for thought is the question regarding the taxability after the tax holiday period is over will still be a debatable issue given that there's a CBDT circular.
So the board circular, as we understand, is always binding on the department. It is not binding on the SSE. SSE, if SSE is advised and takes a view that there's a contrary position under the law, the SSE can take a contrary view. Having said that, the issue, as you very rightly said out, could be debatable or could be an open issue. Insofar as the matter during the holiday period is covered, the deduction would be eligible to the would be available to the SSE.
Okay, sir. Thank you. That was it on the judgment, sir. No more.
Krishna, if I may just add,
Yes,
what the circular says is that this has to be income from business. But what the judgment is saying, and rightly so, whichever head you assess it in, if it is coming from that undertaking, deduction is available. So they are two completely different issues, whether I offer it under house property or other sources or business or whatever head that I want. The tribunal is saying that once it is coming from the source where deduction is available, then the deduction will be allowed.
Correct. No, sir. So what the question seems to be,
as I said earlier, if the SSE still feels that the income needs to be offered for taxation under other head, and as I said, the circular of the board is not binding, and I completely agree with the view expressed that the issue decided by the Honorable Tribunal is not with respect to the issue decided is that the requirement under the section is that the business of SEZ should be carried out. It is not the head of income under which that income is offered would decide the deduction under Section 80 IAB.
correct. Sir, I just reframed the question to put it in a way. So Mr. Sagar Vaidya had a question saying, what benefit DLF could have achieved by showing it as house property? Maybe they want to develop a consistency that is outside the tax, after the tax holiday period. So if I may just put the question verbatim, what is the benefit that DLF achieves by showing it as house property if it is okay to be offered as business income and 100% deduction is anyway allowed?
Well, I would not like to venture into any speculation as to what benefit the SSE might have thought it would derive in terms of offering it under a particular head of income. There could be various factors which the SSE may have considered before offering it under a specific head. So what is really important for the point of our discussion is that what is very clearly held out by three tribunals in three decisions is that the head of income in which it is offered is not important as long as you're carrying on that business activity. And there could be several instances where income could be offered under the head income from house property, or the income could be offered under the head income from business and profession. So there is a thin line of difference in that. And for whatever good reasons, the SSE may have chosen that the head income from house property is the appropriate head of income. Now, the assessing officer's case is not that it is offered under a wrong head of income. The assessing officer's case is that the assessee is not eligible for that deduction if once the income is offered under the head income from house property, which has been overruled by the Honorable Tribunal.
Yes, sir. Yes, if we may move, there's no more questions on this. Yes, if we may move to the next judgment. Neelesh Khandelwal will explain to us a case of ITAT Mumbai. The name of the case is Shailendra Bhandari versus Assistant Commissioner of Income Tax, ITA 6528 of 2018. Neelesh bhai, over to you.
Thank you, Krishna. Yeah, thank you, Krishna. So this is another interesting issue that came up for discussion. Here, there was a person, Mr. Shailendra Bhandari, who had booked a flat on a non-existent floor. The building was sanctioned up to a particular height. The floor that he had booked was beyond the height which was sanctioned. And it seems the AO comes in, somewhere in the judgment, he writes that Bombay Mirror had reported that the sanction is not there, etc., etc. And Mr. Shailendra Bhandari was at a very good post in his job also. So the AO said that Mr. Shailendra Bhandari had all the resources available. He is a learned person and he is booking an asset which is non-existent, for which payment is being made. The payment was made. Unfortunately, the deal was called off later and Mr. Shailendra Bhandari received additional amount of 2.5 crore as compensation. So this compensation amount received, the assessee offered it as long-term capital loss because he did indexation of whatever money that he had paid. The consideration that he received as a refund of the principal amount plus 2.5 crore, he computed the loss by adopting the indexation. The AO said nothing doing, this was not a capital asset, and so the loss that you've claimed is not a loss, it is 2.5 crore income from other sources. So with this background, I'll just run through with the issue involved and the facts more clearly. So the issue involved was whether cancellation of booking of a flat entered into wide letter of intent. So what was executed was only an LOI, would amount to transfer as defined under section 247(6). So specifically the assessee said that this is a capital asset, there is going to be a society made or a company made, so my transfer is under 247(6) of the Act, which inter alia provides that transfer in relation to capital asset also includes any transaction which has the effect of transfer or enabling the enjoyment of immobile property. The second question was whether a right in relation to a capital asset would only include right in relation to capital assets which are in existence at the time of entering into the agreement, or it also includes right to assets to be developed in future. So these were the questions that were before the Honorable Tribunal. The facts were the assessee had booked a flat on 15th floor of a building, which was developed by a company in the name of Kunal Corporation. The booking was done via a letter of intent dated 9th February 2010, wherein various terms and conditions for purchase of property were duly mentioned. So the letter of intent was not just a single page letter. It had its terms and conditions that are normally there in a deed. Via the said letter of intent, the assessee acquired a right to get 2,400 A and B class shares each of a company which would be allotted of the company which would be allotted to him on the completion of building, and these shares would entitle the shareholder to use, occupation and possession of the said flats. So I would be given shares of A and B class on the completion of the building, and these shares would allow me the usage of the ultimate asset which is going to come up. The company had mentioned that one Mr. Mehta, one Mittal, one Bijlani were initially allotted these shares. They had intended to purchase the shares, and these people were also directors of the company. So actually what had happened in the LOI was there was a tri-party agreement between the developer, these three parties who were initially given the allotment of these units, who then gave up this allotment in favor of the assessee. So the said letter of intent had to be cancelled, and the sellers were not allowed to raise the bid. So this letter of allotment which was given to the assessee was later on, it came to the fact that it had to be cancelled because the building could not be constructed. Now, this cancellation affected through a surrender letter, which was signed by the builder and the assessee. The assessee then started following up with the builder that please start giving me my money, because the assessee had given in installments some portion to these three people and some portion to the builder towards the flat for which it had taken allotment. After the litigation started, a compensation decree was awarded, wherein 2.5 crore was the additional amount which was given to the assessee. Now, what the assessee did was, he computed the gross consideration by way of indexation. He took the refund amount and he computed a loss of 3.3 crore. Now, the contention of the AO and the CIT appeal was that the asset for which the letter of intent was issued in favor of the assessee was not existing as of 2010, when the letter of intent was issued in favor of the assessee. There was no asset which was there. Further, they said that when the asset does not exist, where is the question of it being a capital asset? Hence, the additional compensation received has to be taxed as income from other sources. One more issue that was discussed by the CIT appeal was that this letter of intent is nothing but a exercise of raising a deposit from a third party by saying that we are executing a letter of intent and getting the money. So this was only a fundraising activity for which what is termed as compensation, actually interest was paid, is what was generally held by the CIT appeal. So he said that this deposit does not fall under 214. It is not a capital asset. So there is no question of transfer of capital asset for which there will be long-term capital gains. Now, the contention of the AR was that the agreement by which the flats were booked certainly created a right in his favor, which was an immovable property, and upon the cancellation, what the assessee was entitled to was a surrender for cancellation of such rights, was a consideration for surrender of such rights which he had got by the LOI. Hence, anything received in consideration of such rights should be taxed under the head capital gains, is what the assessee contended. What the DR said was that, number one, the asset never existed. Number two, under the MOFA, the Maharashtra Ownership of Flats Act, they say that whenever you book anything, you have to pay 20% of the consideration, and the agreement has to be registered the LOI is not registered, neither it is stamped, nothing has been done. So it cannot be regarded as an agreement. And therefore, there is no interest which is created in an immovable property. There is no asset, and therefore long-term capital loss cannot be allowed. Now, with this factual matrix, what the Honorable ITAT has held is that, number one, the LOI contained all the terms and conditions which are contained in an agreement to sell, and hence the said letter did create rights in favor of the assessee, irrespective of the fact that the property in question was existing or not when the LOI was signed. The other thing that they held was MOFA cannot regulate taxability. What is a long-term capital asset under the Income Tax Act has nothing to do with what MOFA says. What you have to identify is whether it falls under the definition of capital asset under Section 214. And if it does, then it will be long-term, short-term, depending on the period of holding. Another important aspect which needs to be noted is that the ITAT observed that as per one of the clauses, clause number 3 of the letter of intent, what was mentioned that if the company for any reason is unable to build the flat, then it will offer a flat which is below 145 feet, which was the sanction drawing of for which sanctions were available with the company. They will allot a flat in a place which is below 145 feet. So the tribunal, though they have not discussed this too much, they were also swayed by the fact that the assessee had an option to take a flat at a lower floor, which asset would have been in existence at some point of time. Then the ITAT relied on Vijay Flexible Containers, 48 Taxman 86 Bombay, a Bombay High Court decision, wherein it was held that a capital asset is defined by Section 214 to mean property of any kind held by an assessee. The word transfer in relation to a capital asset defined under Section 247 to include the sale, exchange, or relinquishment of an asset or extinguishment of any rights therein. Thus, the right to obtain a conveyance of immovable property fell within the expression property of any kind, which is used in Section 214. Further, the bench also relied on the judgment of Ashwin Bhalekar, a tribunal decision, wherein it was held that the right to obtain conveyance of immovable property falls within the expression property of any kind. And also, what it said is that though the assessee is saying that it is under 247(6), the transfer, relinquishment or extinguishment of a right in an asset is also a transfer. 214, the LOI is a capital asset, and therefore the cancellation of LOI in exchange of a consideration would amount to transfer, and this is a long-term capital loss. So a very interesting decision where though the asset was not purchased, the right in asset created, the cancellation money received against it was treated as long-term capital gains or a long-term capital loss. Yes, Krishna, this is all that I wanted to discuss about this judgment.
So we'll just see if any questions are coming in for the earlier case that we discussed, DLF. But so if I may just ask you a question that I have on the factual aspect of this case, whether it was the refund of the amount paid plus a compensation, or was it a lump sum total consideration against the right held by the assessee?
So what was said was that what is being awarded is 2.5 crore over and above the amount that has been paid by the assessee. So really speaking, it was a compensation of 2.5 crore over and above the principal amount that was paid.
Yes, so I will not indulge you in, because it's a very factual, fact-driven case.
Yes,
Any tweaking here and there. I just had a question on whether it was, if it was cumulative, it is easier to argue what has been laid down in this, that against the right, but when that amount is being refunded separately and the compensation is being received independently of the.
Krishna, what I would think in this judgment is most important is, which of course not elaborated too much in the judgment, is the fact that there is a line put in by the tribunal that though the asset was non-existent because sanction was never received. Now, if we read the judgment plainly, we feel that even if there is no sanction and I make, what do you say, if I book something, a capital asset is created. But what the tribunal is saying is that I had an option to go to a floor for which sanction was available. So therefore, there is a capital asset.
So like I said, yeah, good point. It's very fact driven. I mean, a little tweaking here and there. We don't know what proposition can be laid down.
No, Krishna, only 1 minute. Whether Manoj Fadnis is around?
Yes, sir is here. Sir is here.
Sorry, just.
Good evening, sir. I'm around.
I was occupied in some other institute work, so I could not join earlier. So I just thought that maybe.
Thank you very much for this wonderful opportunity.
Yeah, thank you. We also had a great time with you. Thank you for joining. And only what Krishna said about refund of this whatever amount paid, etc. Had that been the case, perhaps one will not get the indexation benefit. So actually, that would be loss.
Yes.
Because you will the entire compensation may be taxable. So that also aspect you can consider.
Yes.
Thank you. Please proceed.
Yes. Thank you, sir. Nilesh, sir, in case some questions come up on this later on, or if any of the two other panelists would like to add to this, we'll take that up. Or if questions come up, we'll take it later, because participants might be processing it. If at all questions come up, we'll take it later.
Sure.
For all three participants, I will, if at any point of time anyone wants to add onto the judgment that is being the facts or the outcome or the takeaway, please feel free to. I will. Okay. Next judgment is being taken up by CA Vilesh Dalya. This is a case of ITAT Ahmedabad bench. My namesake, it's Krishna Coil Cutters. Vilesh bhai, over to you.
Yeah. So the crux of the case is of the deemed dividend. What has happened to the one of the company Krishna Coil and its sister concern Krishna Sheet? They both had a cross holding. So the one company advanced money to another, and the AO treated as a deemed dividend because the stake was crossing more than 10%. So eventually, when it is to be treated as a deemed dividend, is most important part. In this case, what has happened when the acquisition of the shares was done of the Krishna Coil by the Krishna Sheet, it was done at the later subsequent years. But in the earlier year also, there were certain advances made by the lender to the assessee. And the main business of the, parallel business of the lender was this way, to give money. And whatever the money was given to this company, the assessee company, it was for the joint temporary funding for the certain arrangement. It wasn't paid to the shareholder. So when there is certain arrangements to be entered within the sister concerns, and amount is paid by the one group company to the another company where the limits of the cross holding is there or crosses, then it should be not treated as a dividend. Even as per the CPDT circular number 19/2017, it has been very clearly clarified that the trade avances are not to be treated as a deemed dividend. In the instant case of the Krishna Coil, what has happened? the money was given or money was accepted, but it was for the certain arrangement of the members to procure certain asset jointly. Eventually, it didn't work out because the land what they wanted to purchase, it was means few people were against to give the land, whatever it may be. So whatever the amount was there, AO treated this amount should be treated as a deemed dividend. But looking at the circular and looking at the fact of the case, it was merely point number one. Prior to purchasing the shares of the Krishna Coil, that is the assessee company, and the Krishna Sheet, who has rendered the money, the Krishna Coil has already taken the money in the previous years also. And after several years of advancement, in 1 year, there was a cross-holding purchase and the became a owner. So in the particular year, you cannot say now you have taken a shareholding pattern or you have become the owner of that company. It should be treated as a dividend. So on that prospect, even the Kolkata High Court has clearly stated that deemed dividend has to be given, has to be treated if there is some benefit to the individual shareholder. Here there was no as such benefit to the individual shareholder. The benefit was to the company for the temporary arrangement. So this temporary arrangement has to be given a different shape only. If something flows back to the shareholder, then yes, it can be treated as a deemed dividend. But this arrangement was purely for the business purpose and for the joint, what you say, temporary funding for the expansion of the group, and which it has been considered not to be considered as a deemed dividend. So most important is that you're looking at the cross holding and everything. Fair enough. Deemed dividend has been always a creamy issue, and lot of litigations always arise. But the nature of the transaction which take place between the company or the group company has to be given a due consideration. So in this judgment, it was very clear that the amount was paid earlier after cross-holding. Even the amount was subsequently advanced, but there was no as such benefit coming back to the lender, being the shareholder of the SEC. So it should be not treated as a deemed dividend. Yeah.
Thank you, Vilesh bhai. Manoj sir, or someone would you want to add to the deemed dividend issue that because specifically because this is an intra-group within the group temporary arrangement, would either of you want to add to this?
So deep dividend is rightly a very controversial issue, and it is always a fact-based cases. If the SEC can demonstrate that it is a trade advance, which is in the nature of the business, then the SEC can get out of the deemed dividend liability. Otherwise, this liability would be stuck on the shareholder or the SSE who is the recipient of that loan or advance. And the difficult part is that even if the loan is refunded by the SSE, the fact that he has received that loan or advance, it would come within the ambit of taxability as a deemed dividend.
Yes. Yes, we'll move to the next judgment, which is being explained by us to you, sir. Manoj sir is explaining to us two cases, one of ITAT Delhi and one of ITAT Mumbai. Similar proposition, he will let us know which one he's taking up. This is mainly to do with retrospective amendment to the Income Tax Act. So over to you, sir.
So the next issue really relates to the retrospective amendments which were done by Finance Act 2012, wherein Section 9 was amended after the Vodafone decision of the Honorable Supreme Court, where the Section 9 was amended with retrospective effect from 1st of April 1962. That is the time when the Income Tax Act became applicable. And along with the amendment in Section 9, there was also an amendment in Section 195. So the two issues which I'm discussing, one is with respect to Honorable Delhi Tribunal in the case of, this is in the matter of McCann Erickson's India Private Limited, And the second is in the case of Honorable Mumbai Tribunal in the matter of WNS Capital Investments Limited, Mauritius. Both the cases, the substantive issue which is common is that a transaction took place in somewhere in say 2008-9. At that point of time, the transaction was not a taxable transaction, and therefore there was no requirement for deduction of tax at source under Section 195. Section 195, friends, as we are all well aware, would come into application at a point of time when there is any income which is being paid, any payment which is in the nature of income in the hands of the non-resident. And so 195 would require the tax to be deducted at source. Now in 2008 and 9, when the SEC carried out the transaction was not a taxable transaction. In 2012, the act was amended with retrospective effect and it became taxable. And also with retrospective effect, Section 195 was amended to require deduction of tax at source. So in 2012, the law says that this transaction is taxable. This is taxable straight away with effect from 1st of April 1962. And under 195, the SEC has an obligation to deduct tax at source. So the facts giving rise to the cases before the Delhi Tribunal and Honorable Mumbai Tribunal were different. But the issue was this, that the transaction was not taxable at the point of time when it was undertaken, and subsequently because of a legislative amendment with retrospective effect, it became taxable. So the honorable tribunals in both the judgments have held that what is to be seen is whether the SEC had a liability to deduct tax at source as per the law as it was in force at the point of time when the transaction was entered. So when the transaction was entered, it was clearly a position of law, and as held by the Honorable Supreme Court in the case of Vodafone, that the transaction is not taxable. So later on, the legislative amendment is brought in, which makes that transaction taxable. So the SEC suffers, the recipient of the income suffers to the extent that it becomes a taxable income in the hands of recipient, because the legislature is competent to make a retrospective amendment in the law to clarify that this was always the intention of the law to tax it right from the day the act became applicable. But when there is an obligation to deduct tax at source, that obligation cannot be fastened on an SEC with a retrospective effect. And therefore, in both these decisions, in the case of Delhi Tribunal, in the case of Mumbai Tribunal is in case of WNS Capital Investments Mauritius, where there was a certain reorganization between the group companies. And there were two companies similar to what happened in case of Vodafone. In case of WNS Investments, there were certain group companies under which there was certain amalgamations took place under the Companies Act, which according to the department was the contention was that it was with respect to the property in the subsidiary company which was in India. That is the shares of the Indian company. And that gave rise to the capital gains in the hands of the recipient companies in the course of amalgamations. In the second case before Delhi Tribunal, which is in the matter of McKinsey Ericsson's India Private Limited, that was in context of certain payments which were made. Those payments at that point of time were not treated as royalty in 2008-9, but subsequently it was treated as royalty, and it had to be suffered with deduction of tax at source under Section 195. So Honorable Delhi Tribunal, following another decision of Mumbai Tribunal, and Mumbai Tribunal in the case of WNS Capital Investments, have very clearly held that the liability to deduct tax at source cannot be with a retrospective effect. So the law needs to be seen as on the date on which the transaction took place. And since on that date, there was no liability to deduct tax at source, in these two cases, the tribunals have held that the deductions was not required under Section 195, and consequently no disallowances can be made under Section 40A of the Act, and therefore the additions made were very rightly deleted. I think these are very important case laws because it very clearly clarifies that the tax liability on the recipient can be with a retrospective effect, but the obligation to deduct tax at source cannot be fastened with a retrospective date because it is actually asking an assessee to do something which is impossible to be done. And in light of that, now this issue should be quite settled that the TDS liability cannot be backdated because of a retrospective amendment.
Thank you for explaining that, sir. One good thing about the judgment, if I may, is they have not just said you pay the TDS, we'll let the interest go because it is retrospective and you recover it from the recipient. They have outrightly stated it on record that an impossible obligation, as you said, you mentioned about an obligation being impossible as on that date. They have straight away treated that as not being possible, and therefore the addition has been deleted. Neelesh bhai, Vilesh bhai, any questions, or if you would like to add on the Vodafone second round itself is.
So one thought that comes to my mind with these judgments, where they say that whatever is impossible to be done can't be fastened on a assessee to be complied with, is what they have is the crux of the judgment. So one question that comes to my mind is, currently we are seeing these provisions of ATI-BA. ATI-BA says that the stamp value of the property should not exceed 45 lakh and the square meter should not exceed 60 meters or 45 meters, whatever the case may be. Now, but after 2 years, when the project is completed,
if you could just repeat your last two sentences, we lost you in between.
Okay. So I'm saying that, at the time of sanction of the plan, I'm complying with all the conditions. And after 3 years, the stamp value has gone up, which is not in my control, which has become now 50 lakh rupees. Now I'm being told that, yes, you got your plan sanctioned. Everything was in line when you got the plan going, but now you're not complying and therefore the deduction is not allowed. Can we take any support from these judgments saying that when I went into the scheme, I was complying with everything, and now there is impossibility of compliance? It is not in my control, and therefore you cannot deny me the deduction. What is the thought of the other panelists for this?
So I would say very interesting application of one case law with respect to different very burning issues which you have so rightly brought out. But here, unfortunately, in these two decisions, the matter is specifically with respect to deduction of tax at source. And it is not dealing with deductions available under Chapter 6A. So to that extent, there could be a distinction which the department may like to make out if we try and apply the ratio of this decision with respect to the facts of your case. Because here they very clearly say that the tax liability would arise, but it is deduction of tax at source. So the decisions are confined only with respect to deduction of tax at source. However, the point which can be developed, the issue which could be developed is that what is impossible to perform cannot be asked to be performed. And basis that, I think the issue may have to be looked into with respect to whether at the time of claiming the deduction it is impossible and because of reasons beyond my control, then maybe one can draw some inference from these case laws and apply to the facts of that case. But directly, I doubt whether these case laws would be of very direct benefit, because there could be areas where it could be distinguished. But yes, I appreciate that the ratio of these decisions could be somewhere indirectly referred to and inferred in the matter relating to those which are impossible to perform for reasons beyond my control.
Thank you, sir. Thank you, Neelesh bhai. Very good insight. Everyone probably might dig into these two judgments to see what precedents they used, to develop this argument regarding impossibility and things outside my control.
So what happens is, unless and until we bring this out in the factual matrix right in the beginning, we are unable to develop it for tribunal and high court. So if we can keep this in mind, and before the AO itself, we can take up these issues, then it can develop into a good precedence at a later point of time.
Excellent point. Excellent point. Unless the issue is properly dealt with at the assessment stages, if it is dealt with at the assessment stage in this manner, it could certainly help in evolving the case laws and the law on this point at an appellate stage.
Yes, sir. So thank you for that. Next, so we have two judgments remaining. At the end, Neelesh bhai would just take us through a couple of or three small judgments which everyone should take note of. So we have two more remaining from our panelists.
Only
Next.
Krishna. Hello. As I think Honorable Past President wants to leave, so if we can propose vote of thanks before he leaves, it will be better. He had some other assignment.
Sorry, sir, you are mute, sir. Manoj, sir.
He is having some other occupation. So if we propose vote of thanks for him now,
Sir.
we can continue till the time is available. But
I'll stay back till my case is discussed.
Sir, I requested him. He was more than kind to say, I will stay until you want me to be around.
That's great then. That's great.
Very kind of you, sir.
Thank you, sir. I forgot to reply to your email, sir. Thank you for staying back. Yes. So last but one, CA Neelesh Khandelwal will take us through a judgment of ITAT Mumbai in the case of Bank of India, wherein it deals with the income tax paid by the assessee in foreign jurisdictions and the assessee's claim of refund from the Indian tax authorities of that tax paid in foreign jurisdictions. Very interesting case. Please just pay focus on this one. And thank you, Neelesh bhai, for taking this up. Yeah, it's a very long read. You're on mute, sir.
Yes, it is a really long read, and it's a very, very interesting judgment passed by Shri Pramod Kumar. The issue involved in this very interesting issue, where this Bank of India had branches in several countries. Some countries where there is a double taxation avoidance agreement which has been signed, and some countries where no such agreement is signed. And also a third issue where it invested in two subsidiaries from where it earned dividend, and there was a withholding tax over there. So there were three kinds of taxes that it paid. One where there was a DTA in place, one where there was no DTA in place, and third, there was a TDS done on account of dividend that it was supposed to receive. Now, the refund of taxes that Bank of India claimed was in treaty partner jurisdictions 165 crores, actually 166 crore. In non-treaty partner jurisdictions, about 16 crore, 15.79 crores. And dividend taxes paid was about 87 lakhs. So the total refund that it was claiming was close to 182.64 crores. Now, the issue that came up was that, interestingly, in the beginning of the judgment itself, the honorable member states that we've seen private sectors claiming such refunds for tax payments made. But here is a public sector undertaking which is saying that for the taxes which they have paid abroad in foreign tax kitties, refund should be given from the Indian tax kitty. So their first reaction in the whole judgment is this fair at all, where the tax which is being collected by some foreign jurisdiction under some benefit of section 90 or section 91, you're claiming that that refund should be given in India from the tax paid by the Indian people. So it starts from there. It starts from the nationalist kind of a thought in the judgment. And then, of course, all the points that were brought out by the learned AR have been dealt with by the tribunal. So a public sector bank earned income in such jurisdictions, and a total amount of about 182 crore was claimed as tax refund under section 90 and section 91 of the Act. The submissions of the AR was that on this issue, the settled legal position that the actual payment of tax paid abroad is not a condition precedent for being entitled to tax credit. What it said is that even if I had accrued a tax liability in a foreign jurisdiction, under the provisions of the Act, I should get a tax credit while computing my taxable income in India. The second pleading was that there, again, it is an admitted position that the income of foreign branches has been subjected to tax in both the jurisdictions, and therefore assessee cannot be denied credit of the taxes paid abroad. So what was the fact was, these taxes were paid in foreign jurisdictions where income was earned, and there was a returned loss in India. There was a huge loss in India. So when I clubbed this foreign income into the Indian income, my global income was a loss. So the pleading was, though I am returning a loss income in India, I have paid taxes abroad, and the loss income is also assessed to tax in India. The taxes are assessed to taxes abroad. So the tax credit should be given here. Since as per the provisions, I should have been assessed under the Income Tax Act, I'm being assessed, give me the credit and give me the refund, was the simple pleading of the bank. Then when asked how the said income has been subjected to tax in India, assessee explains that the income in question was includable in its total income in India, in as much as it reduced the entitlement of carry forward of losses. So what it said is, once I have paid taxes abroad, that foreign income, it has been set off against my loss. So I'm not carrying forward that loss in my carry forward of losses. So to that extent, there is a double jeopardy. You're collecting taxes abroad. You're not giving me set off. You're taking net loss over here. So I'm not even getting a credit of that anywhere. So there is a double jeopardy for me. And therefore, this tax credit I'm eligible for. So please give me the refund because I've paid the taxes. Then, as per the assessee, what they said is, subject to tax in India means that income in question should be subjected to tax laws. It does not mean that I should have paid taxes. It should only be, it should have been considered while computing my tax liability in India. So the assessee, with this contention that I have suffered taxation on foreign income, and there is all these provisions where tax credit is available, plus I have lost out on carry forward of losses because my net loss is only going to be carried forward. In this background, and relying on the Karnataka High Court decision of Wipro Limited, which deals with exactly this kind of an issue, where tax credit was allowed, I should be given a refund, is a simple argument that was forwarded by the AR. The DR said that prima facie, for Indian Taxation Authority to give refund for taxes paid abroad seems to be unreasonable and unfair, was one argument that they said, that they made. The second thing that they said is that Wipro's decision is not applicable because it has overlooked or now not dealt with certain high court decisions such as M.A. Morris, R.N. Janji, which are reported in 210 ITR and 185 ITR. These were not considered by Wipro. So Wipro cannot be a good decision, is what the DR argued. Then he also said that on the first principles, this decision is clearly incorrect, as much as all the methods of eliminating of double taxation, that is exemption method, credit method, hybrid method, restrict the liability to tax in the source jurisdiction. So what they said is that these double taxation credits which are available are not for the purpose of refund. These are only to reduce the tax liability in the country in which you are ultimately going to be taxed. So if I had to pay a tax of 100, and if there was a tax credit of 30, then I would have had to pay tax of 70. But if there was tax of 0 and there is a tax credit of 30, these provisions do not say that this 30 will be refunded to you. This is only available as a credit. Now, with all this, now the tribunal has gone ahead and dealt with so many different jurisprudences, gone to the double taxation avoidance agreements, gone to the judgments in UK, judgments in US. It's a read in itself. And what is the meaning of liable to tax? What is the meaning of subject to tax? This has been discussed in detail. It has also dealt with the situation of this double jeopardy, which the assessee has said that it is, the plea of double jeopardy. And what it says is that when you say that there is a double jeopardy, let us deal with the year in which the gain has been set off against the losses. So do you have a double jeopardy in that year? Answer is no, because you have just set off the loss. Double jeopardy would be in the year in which there is an income of the bank, the 8 years have not elapsed for the carry forward of losses, and in that year we have to determine whether this loss is available to you or not. If that situation comes, then you can plead that I have lost out on something. Till then, you cannot plead that you've lost out on anything. So your double jeopardy argument does not hold good for this year. But in any case, it will be unfair to say that it is not available for this year, so it is gone. They said that this issue, we keep it open for adjudication. When you take it up in future years, saying that I have lost out on this additional loss that was available to me, we keep it open for you, is what the judgment is also saying. So it is saying that whenever you feel that this has affected me adversely, you rake up this issue, you plead before the forums, and it will be dealt with by the tribunal. We are putting that as a remark in the order. Now, as far as when it comes to the decision of Karnataka High Court, what they are saying is that Wipro did not, first of all, the tax liability was very less in that case. No one thought that this decision is going to be argued in this manner. And for that, again, several decisions have been quoted that each decision has to be seen as per the facts of the case, the background. It has to be applied in that context only. So picking up Wipro and applying it over here is incorrect, because on the mere fact, on the quantum of taxes itself is a factual difference. And therefore, we will have to look at Wipro in that light, and this discussion in this light is one thing that they have come out with. The other thing that they have said is that even in the case of Wipro, it was not the case of the SSC where it was claiming a refund by claiming a credit. So even if you want to rely on Wipro, they have not dealt with the situation where there was a refund on account of credit granted. So this is a new issue in itself. Keeping all this in mind, they have ultimately come to a conclusion after discussing lots and lots of cases and jurisprudences that this refund cannot be granted. After that, there was one more plea that was taken up, that when you don't grant me a tax credit, whether the taxes that have been paid abroad, whether they will be allowed as a deduction, as an expenditure while computing my income. So if my profit abroad is 100 rupees and I've paid a tax of 25 rupees, what you will give me over here is 75 rupees, or from my total loss, you will add the tax paid as a loss over here, is in effect what was being argued. Then again, several judgments have been discussed, and ultimately the conclusion of the tribunal is that the taxes that you've paid abroad should be allowed as a deduction in your hands, because the term tax, which has been used in they've referred to a judgment of 1922 Act, and then post that, wherein in 1922 Act, such tax credits were not allowed as deduction. So the tribunal has given a finding that in 1922, there was no definition of the term tax in the Income Tax Act. Now, in the current Act, tax has been defined. And therefore, the judgments which are being relied upon by the revenue, saying that this amount cannot be allowed as deduction, are irrelevant now. And therefore, the taxes paid abroad, for which tax credit is not granted in India, will be allowed as a deduction while computing the loss, is what has been held by the tribunal. In gist, Krishna, I've tried to concise the whole discussion in the best possible manner. Would be happy to understand if anyone has any questions, and if I've been unclear in what I have been able to understand from this judgment, please raise the question and I will try to give clarification to the best of my ability.
Yes. Thank you for taking this up, Nilesh. But so no, I mean, obviously, I am not expecting any questions to come up so soon. You have just completed. But my question on the what I had noted down earlier, did we just move from double jeopardy to a double benefit, wherein the tax credit is allowed as a business, a deduction from the income from business, and a ghost loss is being carried forward with me until I make a profit to set it off?
Right.
So
right.
So did we just move from one extreme to the other in this case? Obviously, it was a without prejudice to ground, if I am not wrong. But
No,
the
very,
moment
very
that was
good
allowed-
question. Very good question. So what Krishna, if I rephrase your question, what you are asking is that you have kept a window open to claim this profit which has been set off today as a loss at a future date. If I want to claim that loss, at the same time, you're allowing me the tax payment which I made in a foreign country as a loss today. Is that what your question is?
the last sentence, if you could just repeat.
So what I'm saying is, what you are saying is, one is that you are giving me a window for allowing me a loss in a future date whenever I make a profit. Second way, you are allowing me the tax paid as a loss today, which would not be available if that loss has been allowed in the future.
Yes.
Right?
So
This is the double
jeopardy,
benefit.
double benefit.
Yes.
This is what my question is.
So my reply to you is that, see, they have not said that we are going to allow you that loss at that time. What they are saying is we are keeping the window open to discuss this. Whenever this situation comes up in the future, you bring it up and we will discuss this and we will make a conclusion at that point of time. So they are not saying that we are going to allow you that loss. But at the same time, if they come to a conclusion that this loss is being allowed, I'm sure they will say that this tax credit which we've allowed you as a deduction earlier, to that extent, that loss is not allowed.
Yes. Next time I look at Bank of India, I mean, this is a new age PSU. If I just look at Bank of India arguing this, uh, Vilesh sir, Manoj sir, any just 2 cents on this?
I mean, the fact that it is Bank of India, public sector undertaking, should not make it a different class of SSA before the Income Tax Act. And therefore, the bank is well advised, as per the opinion obtained, to litigate an issue before the Honorable Tribunal. Having said that, yes, it is peculiar given the fact that it's a Government of India owned institution. It is better that such issues are properly settled out. And earlier there was a decision of the Supreme Court which was being implemented in respect of the PSUs and PSBs litigations, that it should be cleared by a high level committee of the secretaries before it can be litigated in the tribunals. Now, however, there's a different view on that matter being taken. Having said that, so far as this issue is concerned, yes, it is very interesting that there is no final view on the matter. To a certain extent, it is left open depending on how the facts really emerge at a later point of time in future.
Vilesh sir, does it remind you of, there's a concept of ghost loss? I mean, we started practice towards the sunset clauses of ATI, ATIB, wherein the initial years there were losses in those eligible undertakings, and you simply carried it forward. So that obviously that was a statutory statutory provision, but it is on a similar line, if I'm getting it correctly. Does it remind you of that?
Yes, because in ATIB earlier, what we used to do, there used to be initial losses. So we used to carry forward, carry forward, carry forward. And once the profit starts, because the span of 15 years, out of 15 years, 10 years were eligible. The same concept, कि जो loss हुआ, बाद में exchange पे हम लोगों ने offset करके ले लिए मजे. But interestingly, this Bank of India was a very good judgment and very nice. One of the PSU has taken such bold initiative and very exception. Otherwise, I have never seen a PSU being so aggressive for the tax matters.
Correct. Thank you, Neelesh bhai, once again for taking this up. Judgments like this, if I just may add, it broadens our horizon rather than the principle here. It's not every day that I will come across something like this, wherein I'm making money elsewhere and making losses in my home country. It will not happen again and again. But the approach when you're practicing at a tribunal level or a consultancy level or any level per se, the approach when you go into consulting, when you read something like this, it actually horizons your it broadens your horizon, as in, yes, if it is something is really tenable, something that can stand, should be argued. Otherwise, at the, like you started this judgment that wherein the nationalist preamble or commentary begins, claiming something like this, by default, the first gut feeling to say, how can you think of this? Claiming a refund of taxes paid abroad. But so judgments like this really reinforce that belief in yourself. Ki if something can be carried to its logical end, why not take it up? Thank you, Neelesh bhai. Yes. So if we come to the last judgment, Neelesh bhai, we'll just, if time permitting, we don't have time. There are 2-3 judgments that you had. If time permits, we'll take them up. But because now gradually faceless appeal orders have very recently started, if I am not wrong. I have not received a single CIT appeal order, but correct me if I'm wrong. They've gradually started trickling in now. So the question with respect to the binding nature of which High Court, because the faceless appeal center is in one place, the jurisdictional AO and assessee is in one place, what would apply? So I would request CM Manoj Fadnis sir to just lay down light on the controversy also per se, sir. What I would request is, if you could explain, rather than the before the case, what is the problem that is leading to this? This is not going to be the only case, if I'm not wrong. So sir is taking up a case of ITAT Agra, in the case of Mahadev cold storage. Yes, sir. Over to you.
So as Krishna mentioned, this is something which is directly related to the way the faceless assessments and the faceless appeals are evolving. And when the concept of faceless assessment came in, the board had clarified very clearly that whatever is the jurisdictional high court decision with respect to the SSE, that would be implemented. And as we know, on various issues, different honorable high courts have laid down the decisions differently. And therefore, although it is a central act, the way it is being implemented in different states is different. So that is the way the law is evolving as of today. And in a state where there is no jurisdictional high court decision, we are reminded of the decision of the Honorable Supreme Court in the case of vegetable products, that whichever decision is more beneficial to the SEC, that decision would apply. Now, what has happened in the case of Mahadev cold storage was, typically this is a matter, before I come to the faceless assessment, as our moderator has asked me to deal with the controversy. The controversy relates to section 3615A, Roman 5A, that Provident Fund employees contribution, whether if it is paid beyond the due date as prescribed in, say, in the Provident Fund Act, but before the due date of filing of the return of income tax, whether that amount would be allowable as a deduction, reading the provisions of section 43B, or as section 3615A says, that if it is not paid within the due date prescribed under that respective act, then it is not allowable as a deduction. So the employee's contribution of Provident Fund, the moment an employer deducts that contribution, the share of the employee, under section 224, it is deemed as an income. Though it is a liability, as far as we chartered accountants and books of accounts are concerned, it is a liability in the hands of the employer. But the way section 2 defines income, the moment the Provident Fund contribution, the employee's provident share is deducted from his salary, it is considered as income. And the deduction of that income is governed by section 3615A, which says that if it is paid within the due date prescribed under the Provident Fund Act, it would be allowed as a deduction. Then we had section 43B, which came in, which said, notwithstanding anything contained in any other provisions, the provisions of section 43B, as we know, that if the amount is paid before the due date of filing of the return of income, it is allowed as a deduction. So certain tribunals and now certain high courts have taken a liberal view, and they said that if the amount is paid up to the due date of filing of the return of income, it would be allowed as a deduction. So if, say, for the month of April 2020, now that for a moment, ignoring the amendments carried out by Finance Act 2021, the controversy is more up to year ending March 20. So let us say we go to April 2019. The salary, the Provident Fund is deducted in the month of May, first week of May, and it is required to be paid, let us say, by 15th of May. And there are 3 days grace period given under the Provident Fund Act. So if it is paid on or before 15th of May or within that grace period, it would be allowed as a deduction. If it is paid even a day after that prescribed due date, certain courts have held that it is not allowable as a deduction. Now, friends, fortunately, we have a decision of Bombay High Court, which is in favor of the SEC. And Bombay High Court, in the case of Ghatge Patel Transport Limited, has held this matter in favor of the SEC. But Honorable Gujarat High Court has held in favor of the department. And recently, there is a decision of Kerala High Court, which has held in favor of the department. Now, the issue which we are discussing is of Mahadev Cold Storage, which is Aligarh in Uttar Pradesh. And the Honorable Allahabad High Court has also held this matter in favor of the SEC, that if it is paid up to the due date of filing of the return of income, it should be allowed as a deduction. Now came the faceless assessment schemes. And although a very elaborate mechanism is provided in the faceless assessment scheme, that there is an assessment unit, there is a review unit. If the review unit raises some issue, it goes to a third assessment unit, and basis that the assessment is framed. So what was conceptualized is that with such maker-checker systems in place, a perfect assessment would be made. Unfortunately, in this case, what has happened is where the assessment was being done, they have not applied the ratio of the decisions of Allahabad High Court. Now, this was actually under 143.1, and under 143.1, the CPC, as we know, clearly disallows that deduction. So the matter was taken up before CIT appeals. Now, CIT appeals was also a faceless assessment. And as CA Krishna mentioned that the decisions of the first appellate on a faceless basis have now started coming in. This case came in a little earlier. Unfortunately, the CIT appeals has applied the decision of Gujarat High Court and held against the SSE. So they have confirmed the addition in the hands of the SSE because the amount deducted on account of employees' provident fund was not paid before the due date prescribed under the Provident Fund Act, but was paid up before the due date of filing the return of income. Now, the SSE carried this matter before the jurisdictional tribunal, which is Honorable Agra Tribunal. And in a way, an issue which had arisen during the debate when Finance Bill 2021 was presented, that even the tribunal hearings should be made faceless. And there has been a lot of hue and cry that tribunals are the last fact-finding bodies, and the hearings may be virtual, but the hearings should not be faceless. And the law minister, the then law minister, had made a statement accepting this, and fortunately those changes have not taken place. Today, the tribunal hearings are virtual because of COVID situation, but they are not faceless. Now, in this decision before the Honorable Agra Tribunal, the Agra Tribunal has very elaborately discussed the issue and said that it is a settled position that if the SSE is in Uttar Pradesh, the decision of the jurisdictional High Court of Honorable Allahabad High Court, that decision is the decision which will apply to the SSE and not the decision of Gujarat High Court. So, on that basis, very clearly the tribunal has held that following the decision of Honorable Allahabad High Court, this matter was decided in favor of the SSE. Now, friends, this whole matter is in a way put to rest by virtue of the amendment made in the Finance Act 2021, and it is actually in a way retrospective because it is made effective from assessment year 21-22. So it is applicable from 1st of April 2020, previous year starting from 1st of April 2020 onwards. So April 2020 deduction not made in time now gets hit by this section, by the way this amendment is made in Finance Act 2021. And now it is open for debate, and actually this may be an issue which could be litigated, that liability is being fastened on me in the month of April 2020, when I believed the jurisdictional High Court's decision that I can pay it up to the due date of filing of the return of income. But in March 2021, you have amended the law and said that to claim the deduction, the amount should have been paid on or before the due date prescribed under the Provident Fund Act. So it leads a possibility of a debate on that matter, and we'll have to wait and see how this issue gets crystallized over a period of time. But as far as the issue and the controversy which continues, so Bombay High Court has held in favor of the SSE, Gujarat High Court has held in favor of the department, Rajasthan High Court had held in favor of the SSE. In the case of Rajasthan State Warehousing Corporation case, the Honorable High Court of Rajasthan held in favor of the SSE. The department took that matter to the Supreme Court, and the special leave petition of the department has been dismissed by the Honorable Supreme Court, saying that SLP dismissed. Even on merit, we do not find it, even on merits, they have said that the case is dismissed. Now, if the Honorable Supreme Court only says SLP dismissed, it is well accepted that it does not lay down a proposition of law. It has just dismissed a special leave petition, and the issue is open for deliberations. The issue is still open before the honorable courts and tribunals to adjudicate the matter. But where even with one line the Supreme Court is dismissing the petition, SLP, and says that this matter is dismissed in the case of Rajasthan State Warehousing Corporation, the department's appeal as a special leave petition was dismissed even on technical grounds, even on merit, which in my humble view is a law of the land. And therefore it could be said that in the case of Rajasthan State Warehousing Corporation, the Supreme Court has upheld the decision of Rajasthan High Court. Now, whether that SLP is to be read as a law of the land, the dismissal of that SLP is held as a law of the land or not, could also be before different high courts for adjudication. So we need to look at this. So as you said, in terms of ATIB, there was a sunset clause, and even with respect to this issue, there is now a sunset clause, because going forward, the SSC has to meticulously make the payment before the due date of filing of due dates prescribed under the respective laws. Otherwise, the deduction is lost forever. And I believe this is a very harsh provision. It's not a labor-friendly provision as was made out by the Honorable Minister in her speech. I would most humbly submit that this is not helping in ease of doing business, which is the mantra which the government is so clearly following. If you look at how the penalties under the Companies Act have been rationalized, how so many provisions under the income tax law have been rationalized, and so much of clarity is brought in the income tax law. So whether for charitable trusts, if a capital asset is acquired and at the time of acquisition, it is treated as a acquisition application of income, and later on whether depreciation could be claimed on it. So today the Honorable Supreme Court has held that yes, before the amendment was made by Finance Act 2015, the law did permit double deduction. And very rightly, the government has now brought that controversy to rest by saying that double deduction is not permissible. Unfortunately, in this case, I would have felt that the government should have permitted the SSC, because ultimately what is important? What is important is that the employee's contribution needs to be deposited before the employee, in the respective provident funds. And if there is a delay, then the employer should be charged interest for that delay. Maybe that interest could be said to be inadmissible. But to say that the entire contribution is not to be allowed as a deduction would be a very harsh provision for the SSCs. And therefore, this is a matter which I think we as chartered accountants could educate our clients and tell them that they need to be very meticulous going forward to see that the contributions are paid in time. Otherwise, they lose the opportunity of deduction for all times to come. And with your permission, moderator, I may just slightly add on this point. See, as a tax auditor, as a tax consultant, my role is different. As a tax auditor, my role is different. Now, if I am auditing an SSC, which is based in Maharashtra, the jurisdictional high court, the decision is in favor of the SSC. So, assuming I have a client, I'm based in Madhya Pradesh, I have a client who's filing the return of income in Mumbai. So, he is guided by the jurisdictional high court, which is Bombay High Court. And therefore, that SSC, for that SSC, the law is clear that the Provident Fund till assessment year 2021, the law was very clear that the amount paid up to the due date of filing of returns of income would be allowed as deduction. But if my SSC is filing return of income in Gujarat, where the Honorable Jurisdictional High Court decision is against the SSC, and if the SSC wants to litigate on that issue and still claim that as a deduction, the SSC is free to do that, because there is an affidavit given by the Government of India in the case of Rajkot Engineering Association that the view of the tax auditor is not binding on the SSC. And therefore, the SSC, if my SSC is filing the return in Gujarat, then if that deduction, with respect to such a deduction, the auditor would be required to qualify his audit report. because the SSC is taking a stand which is contrary to the decision of the jurisdictional high court. Whereas if the SSC is filing the return in Maharashtra, I need not qualify, I need not modify my report because that is in consonance with the decision of the jurisdictional high court. And say if my SSC is filing return of income in Madhya Pradesh, where so far there is no direct decision of the jurisdictional high court, as a tax auditor, I would suggest that the tax auditor should draw an emphasis of matter, because I am following a principle laid down by the Supreme Court in case of vegetable products, that the decision which is more favorable to the SSC is to be followed, and therefore I am following Maharashtra High Court decision. So same issue depending where the SSC is filing the return. The issue is not where the tax auditor is located. The issue, what needs to be kept in mind, is where the return of income of the SSC is being filed, and that jurisdictional high court decision needs to be applied. But in view of the amendment in Finance Act 2021, this issue is now settled so far as the future period is concerned. But the decision which our moderator has brought out for discussion in case of Mahadev Cold Storage clearly brings out the difficulties and the limitations which are there in terms of faceless assessments and faceless appeals. And therefore, it would be very important at the time of assessment stages that proper documents, proper written submissions are filed, CIT appeals, proper evidence is filed. If the evidence was not filed, as an additional evidence, it should be filed under Rule 46A. So that could help the council to take up the matters properly when they reach before the appellate tribunal stages or even in future matters. But this decision of Honorable Agra Tribunal is a very important decision, and it is a laudable decision that the High Court, the jurisdictional High Court decision needs to be followed, more particularly when the CIT appeals is sitting at some other remote place and may not be aware of the decision of the jurisdictional High Court. So this is a good decision which has been pronounced only in the last month, 14th of June 2021.
Yes. Thank you very much, sir. In fact, as I read, there is a judgment of Hyderabad ITAT, which is stating, I mean, it is just reported yesterday, pronounced on 7th of July in the case of Crescent Roadways. I just came across it half an hour ago before the session, which states that the provision amendment is applicable from 1st April 21 as against
Yes.
1st April 20, and most professionals, business and business community agree with you, sir, that anyway interest is being paid under the relevant act. Why penalize in the Income Tax Act? Thank you for bringing that point. And also thank you for bringing across the point that Vegetables India can be argued where there is no jurisdictional high court on that. The view favorable to the SSC needs to be taken. Yes, I think we are running out of time, but just on the last, just on this, Neelesh bhai, I remember you've argued a very nice judgment based on Vegetables India with respect to, if I'm not wrong, deemed rent. You're on mute, Neelesh bhai.
Yeah, on deemed rent.
Deemed rent, yes. I remember you'd argued Vegetables India. I was sitting behind you.
Vegetable products, yes. Vegetable products
Yes.
for view favorable.
Correct. Yes, so I would, we are very short of time. I would have taken more views, or I'm sorry, Neelesh bhai, you've prepared a little more for all of us, but it's already 8 o'clock.
Absolutely no problem.
And if any questions come in, I've just put it in the Q&A box that we may, I mean, if you send it across, time permitting to the panelists, we will forward them with respect to these judgments. We'll forward them to them, forward the questions to them, and they'll answer it at leisure. Yes, I would just like to thank 3 panelists. One again, it was pretty short notice where I've sent the judgments. All of you, I've sent the judgments only yesterday, and all of you have read up on it and done allied research over and above beyond these judgments. Thank you very much, and I'll hand it over to Smita Kunte. Yes.
Krishna, thank you for being such a good, coordinator between the three of us. It was pleasure doing this session where you've, coordinated amongst all the three of us.
So I echo what CA Neelesh mentioned. Thank you very much, CA Krishna, and been a great pleasure to be part of this panel. I'm really impressed by the depth of knowledge of the other two panelists and moderator. Thank you very much to Pune branch for this wonderful opportunity. Thank you.
Really, Krishna, you have done a good job. Even you were given a very short notice period, actually. So thanks a lot, and it was really pleasure with all of you all to be a participant with you.
Cheers, Smita. Thank you very much.
Yeah. Chitra sir, are you there? I'm not sure. So I think I take up this opportunity to thank you all on behalf of the Pune branch of WIRC. First of all, let me thank our wonderful audience who have been there, patiently listening to all of us over last 5 days of DTRC, and today being the last day. I take this opportunity to thank all the panelists. It was indeed remarkable for each of us to listen to the words of wisdom of all the eminent and senior panelists. It was more engaging and interesting because of the case studies that you picked for the discussion. I also thank our moderator, CA Krishna Gujarathi, for a smooth and seamless conduct of this session. So thank you again, and I declare that today this DTRC this year is the session is over. So good night, and see you all.
Thank you very much. Stay safe.
Thank you, sir.
Thank you very much. Thank you.
Good night.